Hi, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. So Jeff published his weekly playbook on Sunday night, which is available on Substack at hugeinsights.substack.com. Jeff, welcome back.
Hey, how are you, Matty? Great to be here.
So we've kicked off 2024, made some highs, but what can things stay this way, Jeff? Talk us through this. Talk us through your thoughts. Let's kick off with the top down.
Yeah, Matty, last week we had a pretty tough week, pretty tough sledding for technology. No question about it. The S&P completed the week down about 1.5%. We had a big comeback rally yesterday, but the first 5 days of the year are down, and that typically does not bode well for the month of January or the year at large. That being said, we've got quite a bit going on this week. Earnings kick off on Friday with a couple of Dow members reporting, both UNH and JP Morgan, plus a slew of other big banks. We also have CPI out on Thursday and PPI out on Friday, so big economic data coming out as well. I think that we're about to get at least some incremental insight as to whether this entire soft landing narrative has any teeth or not. And, we'll find out. From our perspective, we continue to, look at it with some concern. We're not particularly, we have not particularly bought into the soft landing narrative. And as such, we continue to look at a number of other indicators, particularly momentum and sentiment with respect to how it's affecting the market. And we think we're in the wrong neighborhood to commit new capital to stocks right now. We think that there is probably a much larger decline in process, and we think it could probably be the beginning of the next leg of the bear market down. So we'll see how that pans out. But for now, we're continuing to hold kind of a neutral approach to markets, and we continue to recommend our subscribers and those watching that they remain patient, minimize net equity exposure, maximize cash reserves, continue to collect your 5.5% in 3-month T-bills.
Thanks for that, Jeff. Always appreciate your rundowns to kick things off. So as we might have mentioned and people might know, it is 2024, and the cycle composite in 2023 has kind of been a decent indicator for us. So what's the cycle composite spelling out for us?
Yeah, you may recall we talked about the cycle composite quite a bit in 2023. The actual directional path of the S&P 500 was pretty close. I would say it probably 80% in sync with the cycle composite. What was differentiated last year was that the cycle composite actually forecasted about a 10.5% return for the market. The market was up 26%. So, more than doubled the expected return. This year, directionally, the path does conclude to the upside. The expected return is about 5% for the full year, but there are two very harsh declines that are illustrated in the cycle composite chart. And the first one begins in late April and carries through the end of May. So sell in May and go away might come to fruition this year. The other one is later in the year, peaks around late August, and then heads sharply lower into late October, which is the typical seasonal norm. But other than that, a rally off of those October lows into year end to complete the year up 5% is what we're looking for. Will it come to fruition? We'll have to see. What I've found historically is the cycle composite, it's about a 50-50. Sometimes it works, sometimes it doesn't. I like to, just be aware of it. If it begins to work in the first several months of the year, then you want to start paying closer attention to it. But if it looks like it's kind of, the antithesis, which is typically, what we're seeing right now, the first week of this year, down, right? And, the cycle composite for 24 was looking for an immediate up move out of the gate. And so, we kind of got an inverse right away. We'll have to see how it plays out.
So let's talk valuation. I know everyone's been starting to jump on this as we go into the thick of earnings season. So things are starting to look a little bit stretched here, aren't they?
Well, I think they've looked stretched for some time. And, the reality here is that valuations, if you look at it on a trailing 12-month basis, a forward 12-month basis, or if you use the Shiller CAPE ratio, which is cyclically adjusted margins and tax rates, right? And inflation, right? And so, taking the composite of those three measures, we could take a look at how valuations stack up from a Z-score perspective. And they're currently looking like they're more than one standard deviation above their 40-year mean. That's not an all-time record high. That was actually achieved during the technology, dot-com bubble, if you will, back in 2000 and such. And that entire period from around 98 to 2001, we saw valuations skyrocket as prices got way ahead of earnings. The second time it happened was during the post-COVID pandemic reflation period, where the government and the Fed flooded the economy with liquidity and cash, basically to the tune of around $9 trillion. And we saw a huge pop in valuations, not quite to the exact same level that we saw in the dot-com bubble, but very, very close. And at that point, we kind of saw, really, again, prices kind of blow up, but it was mostly because, earnings had crashed, right? And so it wasn't so much that prices got so far ahead of themselves, but earnings had crashed and earnings still haven't caught up, right? And so, I think right now the big issue is, are top-down earnings going to be correct? Now, if we look at this chart and we think about it from the standpoint of what neighborhood are we in, right? What are forward 10-year returns likely to look like if we're paying greater than one standard deviation above long-term valuation mean versus, say, paying one standard deviation below? Well, in the past, back in, say, the early 80s, we had a major bull market from 1983 to 2000, and you bought when earnings or when valuations were, dramatically below their long-term moving average. And actually, if you look back to the end of the great financial crisis, it was almost the exact same situation where you had an opportunity to buy stocks at exceedingly low valuations, and we saw an extended, bull market run off of those levels. I think it's a very bad neighborhood to be committing new capital to equities in based on history.
So, okay, I know you touched on it just there. How do you see these? How do you see this bode for the earnings season we're going into now?
Yeah, two things I'd mention. I've been very skeptical about top-down estimates. Our work suggests that we're on the precipice of a recession in 2024. I know we said that in 2023. It looks like it's been pushed out, but our indicators, and we have 5 different recession models, are all flashing serious warning signals. And that leads me to believe that we're going to get a recession in the not too distant future. We think first half of 2024 is a high probability. It may already be in progress. It's hard to know. The NBER will tell us in arrears, right? They'll tell us after the fact when it began. We think fourth quarter earnings are going to be a nightmare. Revisions to the downside have been really the worst since the great financial crisis. And so fourth quarter revisions really look like analysts are pretty nervous about what's coming down the pike. And if you take a look at the top 100 stocks in the S&P 500, which account for over 70% of the market cap of the index, it looks to us like the S&P is priced closer to 27 times forward earnings, 2024 earnings estimates at this point. I think it's unlikely that we're going to get big revisions to the upside from a bottom-up perspective. I think we're going to see a lot of guide down and a lot of misses as the year progresses. And so it's more likely from our perspective that we see earnings revisions to the downside. And if we take a look at where stocks are priced, and this is on a weighted average basis. So in other words, we're giving 7% to Apple and 0.3% to Boeing. And so, they're all getting exactly what they are ranked at in terms of their weight in the index, in terms of their PE's contribution to this. And And at 27 times, it's well above where the street believes we are priced. Top-down estimates, which are really based on, sector growth assumptions by economists and strategists, and then they're aggregated up and they calculate earnings from that, right? We have a consensus view that we've got $241 in earnings or better, depending who you're talking to. But that's S&P Global's consensus that they're publishing, 241. I think that number's way high. We're thinking something more like a 15% year-over-year decline if we get a recession. And that would get us to around 187. So, the bottom-up numbers are telling us that, the S&P 500 is valued much more richly than even top-down analysts believe it to be. The number I hear bandied about in the financial news media is 19 and a half times forward 12-month earnings. I don't think that's correct. I think it's 27 times.
So, Jeff, this now changes my thoughts going into this next question, but let's have a look at the technicals. And I was going to ask you, is the bullish alternative starting to look a little bit more likely based on some of the things that you've been saying? But after that, the last commentary in regards to earnings, I don't really see that being the case.
Well, the way I would describe it is that the bullish alternative is not bullish at all. From where we stand today, there's, a couple hundred S&P points potential to the upside if the bullish alternate comes into play. That won't happen unless the S&P 500 makes a new all-time record high. It has to exceed 4818 in order to, basically invalidate our preferred count, which is a bearish count, and initiate the bull count. But we think a double top is in development here, and whether it's the peak that we've already seen in the S&P for this recovery rally, we've retraced some 98%. It's possible for second waves or B waves, whichever this is, to retrace up to 100%, but no more. And so we're very, very close to that barrier, which would invalidate our preferred count. So far, we haven't made a new high, so we're sticking with the preferred count. The preferred count suggests that we've been in a counter trend advance off of the October 2022 low. We're counting it as a double zigzag. We believe it's wave 2 of a 5-wave impulse pattern that will play out over the next couple of years and complete cycle wave A down of an ABC. Sort of corrective waveform at super cycle degree of trend. That's liable to take the better part of a decade to completely, get through. If we're wrong about that, if the market makes a new high, then the next best count is that the October low was primary wave 4 of, a larger cycle degree advance that began in 2009. And that cycle degree advance has not yet completed. But what we probably have seen is at least 4, and we're in the midst of the 5th wave. So we're very, very close to completing it. And if in fact our calculations are correct, and the way we get there would be if cycle or if primary wave 5, advances to the tune of 2.618 times primary wave 1, which is a common relationship between wave 5 and wave 1. Then we would get to 4940 on the S&P 500. That's our top target. Now, I know there's a lot of people out there with targets around 5,100 or 5,300. We actually looked at it a different way and thought maybe 5,100 was a possibility, but this actually makes more sense from a structural perspective. And so, our target would be 4940. Okay, that's 100 and some odd points above the the January 4th, 2022 high. And so, to us, it's just a double top of a different form, right? That would likely end the entire cycle wave 5. It would end super cycle wave 3, and then we would begin super cycle wave 4 with 5 waves down. That would probably be a very aggressive decline. So from our perspective, it's 6 to 1, half a dozen another. Maybe the bulls have another 200 points of upside. If we're right, if our preferred count is correct, then we're already in the midst of the next leg of the decline.
That's understandable. So, okay, so just as we clarified last week when we spoke, at the end of the day, you've got it as a bullish alternative count, but still we end up in the same place at some point. So, how's sentiment? How's investor sentiment look?
Well, sentiment's one of the things that has us so concerned about the market's current position and is reinforcing our view that we have been in a corrective counter trend advance. And that is because sentiment reached new extremes. Okay. We got within the name exposure index, this is the National Association of Active Investment Managers, it got to a leveraged 102.7% and has turned sharply down. Now, we usually don't turn sharply down and then go on to make new highs. Typically, you peak out at around that level, 100, 105%. 102 is pretty high. We haven't seen a leverage number higher than that since 2021 when the NASDAQ 100 reached its initial high. So, we took out the peak that was established in July, which is 101%, and now we've turned down just like we did in July. And I think it's the beginning of the next leg down in the market. Now, we can also look at this from the perspective of individual investors. Individual investors usually are a pretty bearish cohort to begin with. They rarely ever get to a point where the bull-bear spread exceeds 30%. Well, for 2 consecutive weeks, we got to 32%. That was a couple of weeks ago, and we've now turned down. It's currently around 25%. And our suspicion is that that also marks the top in investor sentiment for individual investors. Another chart we're not showing, but can actually be found in our monthly investment newsletter, Huge Insights, The Big Picture, which is available on Substack at hugeinsights.substack.com. We actually lay out 6 different measures of sentiment. And another one that really catches our eye is advisor sentiment. This is the Investors Intelligence Advisor Sentiment Survey. And if we look at net bullish sentiment there, it made a new 2.5-year high. So, we've got a 2-year high in the name index. We've got a 3-year high in the AAII survey. We got a 2.5-year high in the II Advisor survey. I mean, those 3 surveys in and of themselves cover all of the main areas of different investor groups, right? Institutional investors, advisors, and individual investors. We could also look at, trader sentiment, option trader sentiment. And with the VIX down, in the low teens, just bouncing off 12%, that tells me that, options traders are pretty complacent as well. And, we've talked about CTAs and, options market makers really having extreme exposure to global equities on the long side right now and extreme positive gamma in their books. And so, I think it all adds up to a bullish extreme in sentiment. And that's typically a neighborhood that marks a major turning point in the direction of the trend. And the direction would be to the downside from there.
So, Jeff, looking at the S&P 500, what do the internals look like?
That's another big area of concern. And we also address this in detail in the newsletter. And what we talk about in the newsletter is how momentum has actually peaked at a daily time scale, at a weekly time scale, and at a monthly time scale, and is actually diverging negatively relative to price. And that's typically a precursor to a major trend change. What we're looking at today is 3 different measures of market internals: breadth, momentum, and sentiment. The top frame looks at momentum, and we can see that we've seen a sharp decline. Breadth has actually plummeted from its recent highs, which made a lower high than, say, the summer highs, the June, July highs, which is a negative divergence in and of itself. The 5-week moving average of net advancing issues is now negative. Looking at an intermediate term momentum measure, which is the 5-week RSI oscillator, also putting in a major negative divergence and breaking down from overbought, which is typically a signal that momentum is reversing. And then finally, net advancing volume, very flat we're not seeing any compelling demand for equities on the net advancing volume side either. So internals look like they've peaked, and they look like they're rolling over from our vantage point.
So, Jeff, we're on slide 7. That can only mean one thing. Let's talk about the Magnificent Seven. So, obviously, they were a very, very hot topic through 2023. How are they looking so far?
Yeah, the first week of the year was a tough week for the Mag 7. All finished the week in negative territory, none worse than Apple, which I think suffered from a couple of major houses downgrading the stock. It was down roughly 6% last week, but all said, this entire cohort of stocks, which kind of carried the market last year, is all negative for the year through Friday's close. I don't think yesterday's rally changed that across the board, although there were a couple of them that were kind of borderline. I think NVIDIA had a pretty good day yesterday, and that could have put it in positive territory for the year. But we'll see. Meta possibly as well.
So, Jeff, I know you obviously publish your top actionable trade ideas. So I would ask our viewers to go and subscribe to your weekly newsletter and your monthly to get more color on those. But let's talk some higher level sectors. How should people be looking to position themselves? And if you could break it down, from a valuation perspective as well as a sector relative strength perspective as well, that'd be great.
Absolutely. So two things we're looking at. We're looking at margin of safety from a valuation perspective. And the problem that we have with technology is you just don't have any kind of a margin of safety there. Tech is valued at a 50% premium to the market. The flip side of that is energy is valued at a 50% discount to the market. And so I think there's a real margin of safety in energy. The problem is the relative strength of energy has really faded quite a bit. It was the worst performing sector last year, the only sector to finish in negative territory last year. And from that perspective, it seems like we could get a bounce in energy. It seems like it's a sector that I'd want to at least have market weight exposure, maybe a slight overweight at this juncture to try and benefit from a bounce. It was one of the better performers in the first week of the year. Healthcare is another area that I think could be a candidate to bounce. So the sector was up 2% last year, fared very poorly. I think that there's still growth in healthcare, and so growth should catch a bid, and healthcare should catch a bid with it. And it looks to me like, from a valuation perspective, we don't have the margin of safety that we probably would like to have, but I think that it's pretty overdone. So those are two kind of, I guess, long shots that I'd consider. What's working right now from a relative strength perspective, the best is REITs and financials. Tech has been working, but it's starting to roll over. And I think it's too late in the game to commit new capital to technology. I'd be looking actually to lock in gains and shore up my positioning around there. I think comm services is experiencing a negative momentum surge right now. So it's reversing. We're getting a big reversal there as well. I think discretionary is kind of languishing. And those three sectors in general, I think I would avoid or reduce. I think healthcare would be one of my number ones on the long shot side. I also think defensives like utilities and staples, which fared pretty well last week as well. It looks like those could be attempting to stabilize. And, I think the valuations are still reasonable in those areas. So, I think I'd be playing more defense in 2024 from a sector rotation perspective. Cyclicals like materials, industrials seem to be languishing as well. And so those I would have more on the equal weight side.
Definitely seems like weighing up your risk versus reward and how you invest your money. So, I would urge people to check it out. And Jeff, as always, thank you so much for sharing your thoughts from Alpha Insights.
It's always a pleasure, Mehdi.
And don't forget, check it out for yourself. As I just said, Substack, hugeinsights.substack.com. Get there now. Thank you for watching, and obviously, good luck investing.